So it's quite fascinating. Now look at this. Let's skip out from 15 years to 20 years. You're now yielding 20% yield on cost. This is life-changing. I want to discuss today an important financial metric for dividend growth investors. That's the metric of yield on cost. I feel like this metric is ignored in the financial industry, I think in the personal finance industry. And as all of you probably know by now, I have a huge passion for investing in dividends, in stocks that pay cash flow, in dividend growth stocks. And honestly, in this economy right now, with the interest rates so low, it's difficult to get yield anywhere. And for us dividend growth investors, our ultimate goal is to live off of cash flow, to have enough cash flow coming in to our pockets so that we can live off that and do pretty much whatever we want, whether that's have a job, take free time and relax, pursue charity, pursue our passions, whatever it is, that passive income that's coming in, it provides a cushion, it provides security, it provides options in life. So if you're just getting into dividend growth investing, you might be thinking, well, I can purchase a stock, it has a 3% yield. That's not really going to get me anywhere. That's not really helpful. And that's true in the short run, in fact. Like, let's say you buy a stock right now, you have $1,000, you buy a stock that yields 3%. Well, that's actually right here on my table here, yield on cost. In year zero, if you put in $1,000 right now, you're only going to yield at 3%, $30 per year. That's just $1,000 investment times 3%, $30 a year. Not much, not really going to help you. But here's really the key of this concept called yield on cost. If you invest in high quality dividend growth stocks, stocks that have a proven track record of increasing their dividend yield year in and year out, these are the blue chip stocks, the stocks that have been around forever, the ones that have promising business models. Well, these companies have a track record of increasing their dividend each year, and some of them quite aggressively. So what I have today in front of you here is a model. Very simple, but the model really looks at the concept of yield on cost, and it looks at an increase in dividend each year of 10% over time. And what I'm trying to illustrate today is even though your starting yield is 3%, your yield on cost after time has passed will be far greater if you invest in the right companies at the right price, the ones that increase their dividend each year. So let me illustrate this concept through example. Year one or 1 year into it, your $1,000, still the same investment. Let's just say for this particular example, you're not investing more money. Well, look, the dividend has increased. Your company increased the dividend by 10%. So your yield on your cost has actually gone up by 10%. So you're no longer at 3%, you're at 3.3. So let's hypothetically say that during the same year, the price of the stock has gone up as well by 10%. So if you were to buy the stock again, your starting yield would be 3%. But because you leveraged time to your advantage, you let that year elapse, you took advantage of the increase in the dividend, your yield on cost is actually 3.3. So there's a huge difference here between your yield on cost and the starting yield. So again, someone who starts out after 1 year has elapsed, year two, or here I have it labeled as 1 because we started at a 0, their starting yield is probably still going to be around 3%. Let's just assume that because the price of stocks over time, they're quite volatile, but generally trending up. So your starting yield is going to be 3%, but your yield on cost, because you bought a year ago, has gone up to 3.3. Still not a game changer. Are you going to be able to live off of this $33 for a $1,000 investment? Probably not. But let's keep looking here. Let's keep going. Year two. So 2 years of time have elapsed now. They increase the dividend again. 3.63% now is your yield on cost. Again, someone gets into the stock at this point, they're probably getting an entry yield around 3%. But because you started 2 years ago, you bought on early, you've enjoyed these dividend increases, your yield on cost is 3.63. Again, not a game changer because you're still at $36.30 dividend income per year. And I think this is why people actually don't pay attention to yield on cost, because quite frankly, in the first few years, it doesn't really matter. well, I shouldn't say it doesn't matter, but it's slow to see the change. It's not game changing, it's not life changing in the first few years, but as a lot of time elapses, it is life changing. So let's actually skip forward now. I have a ... to 5 years out. If you compound a 10% dividend increase over 5 years, you're now looking at 4.83%. You're getting close to a 5% yield. If you look at the broader market today, getting an entry yield of 5%, it's possible, but not very easy, especially in a very, very high quality, fast growing, dividend growing company. But still doable, not game changer. It's not very exciting to see 5%. But what about 10 years? Now we're at 7.78%. This is where it starts getting hard to achieve these yields as an entry yield. It's very difficult. And the beauty of this is you're yielding 7.78% on your initial purchase price. But again, people getting in 10 years from now, price of the stock has probably gone up. Their entry yield is probably similar to the 3% that you enjoyed when you first bought the stock. So this is really the power of yield on cost. But again, even at 10 years, 7.78, it's nice, but it's not life-changing. In fact, you can still buy stocks. I mean, you're probably looking at a little bit on the riskier side with an entry yield in that arena. But again, it's not going to change your life at 7.78%, but it's starting to get there. Here's where the magic happens, and this is why if you subscribe to dividend growth investing, if you subscribe to this long-term model, you really have to stick with it. You have to have a longer-term vision, and that's what I do. I have a 20, 30-year horizon in my investments that I personally make. Now, check this out, 15 years. This is where it starts getting interesting, 12.53%. You're now all of a sudden yielding $125 per year on your initial investment of $1,000. This is getting to be life-changing at this point because basically now in less than 10 years, even if they don't raise the dividend again, you're paying for your initial investment in just 10 years' time. So it's quite fascinating. Now look at this. Let's skip out from 15 years to 20 years. You're now yielding 20% yield on cost. This is life-changing. To get a 20% yield on a high-quality company, a brand name that's stable, the dividend income isn't going to go away, especially if you diversify really well. This is why yield on cost, in my opinion, is an underrated financial metric for personal finance, for dividend growth investors. And I think it's something that all of us should be focused on. So again, look at things through that lens. Don't necessarily, like your starting yield is important, but what's more important in the message today is time. If you get in early, you buy the right companies, you put in the time, you just wait, you're patient. You don't trade in and out. You're just laser focused on your long-term goal. You do have an opportunity one day to reach this 20% yield or even more on your initial investment. And in fact, some of the stocks that I bought around 2007, 2008, I've actually surpassed 10% yield on cost in my personal portfolio. So I'm seeing this play out. I'm actually seeing it play out ahead of schedule for using this hypothetical example. And that's what's great is some stocks, they may beat this schedule, some may stay on schedule, some may never hit this schedule. And that's why it's important to diversify as well and to have a diversified game plan. So PPC Ian, ppcian.com, very passionate about dividend growth investing. Just wanted to share this concept with all of the dividend growth investors out there today about yield on cost. And really key takeaways today is to get started, stay in it for the long run. Don't be discouraged by the small numbers in the short run because your dividends in the long run on your initial investment are going to be huge.